Hi CA students, let's revise CA Final AFM Chapter 4 Security Analysis Practical Question 1. They have given closing values of NSE Nifty from 6th to 17th day of the month of January of year 2020 and 12 days values are given and Sensex points for the dates are given. We are asked to calculate exponential moving average of Sensex during the above period. The previous day exponential moving average of Sensex can be assumed as 15,000. The value of exponent 31 days EMA is 0.062. They have given previous day EMA and exponential A, they have given 0.062. When we apply these values in the formula, we'll anyway going to get the answer. But let's see what is this exponential moving average. So I'll just compare it with this simple moving average for a better understanding. Simple moving average is nothing but the weighted average. Now here I've given one example of a normal stock and for 7 days, so wherein the prices are given. Now as we can see in the simple moving average, the prices are not that much predictable as it is just an average and it will not account for the immediate hike in the prices or immediate fall in the prices. As you can see on the day 3, the price the SMA is 24 and for day 4 it is 25 and day 5 it is 25, day 26 and day 6 it is 27, going to exponential moving average. But if you see in this weighted average, it is not fair as what if the price in the 7 day goes to 50 but still my average will not account for will not give more weight to the 50, or if the stock price in my previous day has gone double the amount of 30 into 2, let's say 60, but my weighted average will average it out. But ideally I should give more weight or less weight based on the parameters, right? So exponential moving average is one such technical method wherein it will give more weights to the previous sudden hikes or sudden lows. So now the same example, same price I have taken here, and I have taken for the 5th day. For first we'll see the formula. So exponential moving average can be found out by the exponent, so I'll explain the exponent also, and multiplied by today's price plus 1 minus the exponent multiplied by previous day's exponential moving average. Now by this formula we can see, let's say if my exponent is 0.4 for 4 days, then I will give 0.4 weightage for the current day and 1 minus 0.4, which is 0.6 weightage for the previous EMA, thereby giving more weightage to the previous day trends, right? Now this exponent is nothing but 2 divided by n plus 1. So this formula ensures that when the exponential moving average is calculated for the more and more days, the exponent will reduce. We can see for 3 days average it is giving me 0.5, wherein the current day and previous day will have equal weightage, and going further for 4 days it will give less weightage to the closing current day and more weightage to the previous day. If we go for 5 days, then 2 by 6 will give us 0.33, so it will give only 0.33 weightage for current day and 0.66 weightage for the previous day. So by this exponent it is ensured that more weightage is given to the previous days. In the same way, in the current example also, the 3rd day EMA is taken as 24 for the initial EMA, the same simple moving average is taken 24. And going further for the fourth day, as we can see, fourth day's price 50% weightage is given, and previous EMA is given 50%. Instead of weight of this 24 and 26, the weight is given to previous day EMA. Going to the fifth day, same case goes with fifth day. The current price of 27 is given 50% weightage, and previous EMA is given 50% weightage instead of 26 and 25, thereby ensuring the more weightage to previous hikes and lows. Now coming to our solution, now we understood this formula. Now in ICAI solution you can see this formula, and they've given an alternate formula of this one. I'll just show it to you. Yeah, so they've given this formula: EMA equal to exponent into price of today plus 1 minus A into EMA of previous day, which is T minus 1. Now they have given an alternative formula: closing price of the day minus EMA of previous day into exponent plus previous day EMA, which came from this formula only. I'll show how. So exponent multiplied by PT, which is today's price, plus 1 minus A into EMA T minus 1, which is previous day EMA. So if we multiply this EMA into 1 and A, then we'll get EMA of previous day minus exponent into EMA of T minus 1. Now this exponent is multiplied in both the cases, so we can take it out. Then PT minus EMA T minus 1 will become the new formula, then plus EMA of T minus 1. Now if you see, this and this are same, so exponent is multiplied with closing price of the day minus EMA of previous day. So same case, the closing price of today minus previous EMA plus previous day EMA. So both formulas are same. Now going to our solution. So they have given Sensex of different dates. Now exponential moving average they are asking, and they have given the initial EMA, which is the previous day EMA which we require, that as 15,000. Now they have given the exponent also, which is 0.062. So for current day only 0.062 weightage will be given, and the more weightage is given for the previous days. Now plotting this in this table, Sensex of current day is 14,552 and previous day EMA is 15,000. Reducing this to, we are getting the difference of 478, which we will multiply with the exponent, and we are getting 29.636. Then again we will add this to the previous day EMA, which is 15,000. If it is negative, then we will add, add or subtract based on the resultant. Now here we got an EMA of 14,970.364. So by this we can see the previous day 15,000 has given more weightage because the exponent is 0.062. Then going further, following the table, the next day Sensex is given as 14,925. Then previous day EMA is considered 14,970. Then the difference between that is 45.364. Multiplied with the exponent of 0.62, we are getting 2.812. Then again subtracting it with the previous EMA, we are getting 14,967.55. And going further, 14,983 for the next day. Since there is no trading for 2 days, we don't need to consider that. So we have to take the previous EMA only. So there's a Sensex on closing date on the 10th. So 10th date, even though there is 3 days gap, since we have to take the previous EMA here, 15,222, and previous EMA minus this multiplied with the exponent, then we'll arrive at the EMA. Now going further, same way goes for all the till the trading period. Now they are asking give detailed analysis on the basis of your calculation. Now as we can see, the market is bullish. If the prices of the market continuously increases, that signifies a bullish market. So they've given another comment: the market is likely to remain bullish for short term to medium term if other factors remain same. On the basis of indicator EMA, the investors can take long position. So long position is nothing but buying as of now with an intention that the stocks will go to a high price so that we can sell later on. That is what signified here. Thank you. And sorry, actually before going to this exponent is, in my example I've given a 2 by n plus 1, which is for the understanding purpose how exponent is giving the weightage to the formula. In real world terms, exponent is depend on many factors. So the weightage is based on many factors like market trends, global trends, and everything. So in most in ICAI questions, though, they will give directly exponent. For our sake, for understanding purpose I've given, so we should not use this 2 by n plus 1. Exponent will be given in the question itself. That's it. Thank you.